Something unusual just happened in the global financial system. It wasn't announced in a press conference. There were no emergency headlines, no flashing red alerts on television screens. But behind closed doors, inside the balance sheets of central banks, a line was crossed, quietly, deliberately, and without explanation. Central banks around the world just took actions they have never taken before, at least not in this form, not at this scale, and not under these conditions. And here's the part that should concern every investor, saver, and worker watching this right now. They are not explaining why. If this sounds dramatic, stay with me for the next few minutes, because what you're about to hear is not speculation, not conspiracy, and not fear-mongering. It's a pattern hidden in liquidity operations, reserve behavior, and policy contradictions that most people never see because they're buried in technical language. But once you see it, you can't unsee it. And by the end of this video, you'll understand why. The world's most powerful financial institutions are acting first and speaking later, if they speak at all. Welcome to Financial Freedom Desk. If you value clear economic analysis without hype, take a second to like this video and subscribe to the channel. It helps more than you think, and it keeps this kind of content alive. Now, let's get into it. For decades, central banks followed a predictable playbook. When inflation rose, they tightened. When economies slowed, they eased. When markets panicked, they provided liquidity, loudly, visibly, and with carefully crafted explanations meant to reassure confidence. Policy toolset. Markets needed guidance, forward signaling, and consistency. The predictability became the foundation of modern finance. But something changed. Over the past year, central banks began operating in two parallel realities. On the surface, they speak the language of restraint, higher interest rates, balance sheet reduction, inflation control, financial discipline. Yet underneath that surface, a very different set of actions is taking place. Emergency lending facilities expanding, collateral rules quietly loosened, reserve assets shifting in composition, and liquidity flowing through channels that barely existed a decade ago. These are not standard adjustments. These are structural deviations. The first red flag isn't what central banks are doing, it's how quietly they're doing it. Normally, extraordinary measures come with extraordinary messaging. Think back to 2008. Think back to 2020. The world is told exactly what was happening, why it was happening, and what tools were being deployed. Today, the tools are being deployed without the narrative that silence is not accidental. It suggests fragility, because when confidence is thin, words can do more harm than good. Here's the hook most people miss. Central banks are no longer trying to guide expectations, they are trying to avoid triggering them. Take liquidity. Officially, we're told liquidity conditions are tightening, rates are restrictive, financial conditions are appropriately firm, yet banks are accessing central bank facilities at levels that don't align with that story, not in a crisis spike, but persistently, quietly, almost routinely. That's new. Historically, emergency liquidity was a last resort. Today, it's becoming part of normal operations, and when emergency tools become routine, it tells you something is broken beneath the surface. What's broken is not demand, it's trust between institutions. Banks no longer fully trust interbank markets. Governments no longer trust bond markets to absorb supply smoothly. Central banks no longer trust forward guidance to stabilize behavior. So instead of one big dramatic intervention, we're seeing constant micro-interventions, small enough to avoid headlines, large enough to prevent cracks from widening. And this is where the story gets uncomfortable. Central banks are effectively saying one thing while preparing for another. Publicly, they talk about stability. Privately, they're preparing for stress. That divergence is unprecedented in modern monetary history. Look at reserve behavior. Central banks are adjusting the composition of reserves in ways that don't match their public confidence. Some are increasing hard asset exposure, others are shortening duration. Some are building buffers in currencies they rarely prioritized before. These aren't theoretical shifts. They are defensive moves, and defensive moves mean perceived risk. The reason you're not hearing about this is simple. Admitting fragility would accelerate it. Central banks operate on confidence the way airplanes operate on lift. Once it's gone, gravity takes over very fast. So instead, they choose silence. Now here's where this directly affects you. When central banks operate quietly, markets lose their most important anchor, clarity. And when clarity disappears, volatility doesn't vanish, it migrates. It hides. It builds pressure in places people aren't watching. That's why markets can look calm right before they're not. That's why asset prices can stay elevated even as liquidity underneath them thins. That's why risk doesn't feel expensive until suddenly it is. This isn't about predicting a crash. It's about understanding conditions. Conditions where policy tools are being stretched beyond their original design. Conditions where central banks are improvising instead of orchestrating, and improvisation at the top of the system filters downward. Corporations feel it through tighter credit despite stable earnings. Governments feel it through higher refinancing costs despite steady demand. Households feel it through persistent inflation even as growth slows. These contradictions don't happen in healthy systems. They happen in systems under strain. Let's talk about inflation, because this is where the silence becomes deafening. Officially, inflation is moderating. That's the narrative. But central banks are acting like inflation risk hasn't disappeared. It's just changed shape. Instead of broad consumer inflation, they're worried about asset inflation, wage persistence, and supply-driven price shocks. Those are harder to control, harder to explain, and politically dangerous. So rather than declare victory or defeat, central banks are choosing ambiguity. They raise rates but backstop banks. They reduce balance sheets but expand emergency facilities. They warn about excess risk while quietly absorbing it. That combination has never existed at this scale before. In the past, tightening meant tightening, easing meant easing. Today, we have both at the same time, depending on where you look. That's not policy clarity, that's damage control. And here's the hook that keeps professionals awake at night. Damage control assumes something has already been damaged. Now, if this analysis is helping you see the bigger picture, take a moment to like the video and subscribe to Financial Freedom Desk. We focus on understanding systems before they break, not after headlines catch up. Let's talk about why central banks don't explain this direct. The answer is credibility. Central banks built their authority on the belief that they are in control. That belief is more powerful than any interest rate. Once it's questioned, every policy tool becomes less effective. So instead of explaining unprecedented actions, they normalize them through repetition. If something happens quietly enough, often enough, it stops being news. That's the strategy. But normalization doesn't remove risk, it redistributes it. Banks adapt by holding more liquidity. Corporations adapt by delaying investment. Investors adapt by chasing perceived safety. And the real economy adapts by slowing, even if GDP numbers don't immediately show it. This is how stagnation begins. Not with collapse, but with caution. And caution is contagious. Now let's be clear. Central banks are not villains here. They're responding to a system that has accumulated decades of leverage, complexity, and dependency on cheap money. There is no clean exit. Every path forward carries consequences. What's new is that they are no longer confident enough to explain those consequences publicly. That alone should tell you how narrow the margin has become. So what does this mean going forward? It means markets will be more sensitive to small shocks. It means policy mistakes will travel faster. It means confidence will matter more than data. And it means those who understand the structure, not just the headlines, will be better prepared. This channel isn't about telling you what to buy or sell. It's about helping you see when the rules change. And right now, the rules are changing quietly. Before we wrap up, here's the most important takeaway. Central banks didn't suddenly become secretive. They became cautious, and caution at the center of the system tells you risk hasn't been eliminated. It's been deferred. Deferred risk doesn't disappear. It accumulates. If you found value in this breakdown, share this video with someone who follows markets but feels like something doesn't quite add up lately, and leave a comment below. Do you think central banks are in control or just buying time? This is Financial Freedom Desk. Stay informed, stay curious, and I'll see you in the next one.